This week on the Retirement Quick Tips podcast, I'm answering your questions. Today, I'm answering a common question I get right now, or some variation of it, which is basically, are we headed for a recession? Are we in a recession? What's going on? How are tariff policies and everything else impacting the markets and the economy? And there's an interesting dominoes chart on Charles Schwab Asset Management website. It came out a few weeks ago at the end of April. And I like it because it's a nice visual and it paints a very mixed picture. So if you think of, there's all of these indicators of a declining or deteriorating economic situation. And some of those dominoes have already fallen. Some of those are kind of a mixed bag. And then some of those haven't yet fallen. It's a nice analogy for what happens. So if you look at this particular dominoes picture, these are the things that have already occurred. Stocks fall. PE, price to earnings ratios of the stocks broadly fall, volatility rises, economic uncertainty spikes, consumer confidence falls, manufacturing, there's a particular index or metric that if it falls below 50, that's generally an indicator of a slowdown. And then you have some things that are mixed. Inflation is still pretty stable. It hasn't ticked up. The housing market has kind of deteriorated. I'll come back to that. The labor market has actually weakened somewhat. And again, I'll talk more about that because there's a lot of these mixed bag figures and we have consumer spending that has slowed, but we still have a few things that are hanging in there. Credit hasn't tightened. GDP is still pretty stable. We haven't seen a decline yet in GDP, so it's still positive, but it is trending downward. And future forecasts, even before tariffs, were indicating that GDP would slow down. So there's not a lot of wiggle room in the current GDP. It's not like the economy is growing at 5, 6, 7, 8%. The economy is growing at like 1, maybe 2%. So anything big or small like tariffs and the uncertainty related to that is truly enough to push the economy over into a recession. But it hasn't officially happened yet. The problem though is I put that in quotes because the official declaration of, hey, we're in a recession, it's usually like a year after the recession has started. They basically go back and say, okay, the recession started in June of 2024. And you're like, great. Well, it's a year later. Thank you very much. So that's typically what happens there in a recession. But one of the first signs is what's happening in the stock market and the volatility of the stock market. So the stock market peaked in mid-February. So this is even before the tariffs. We cannot blame the tariffs for all of this, although it has been a big contributing factor to the drop-off in stocks since February. So we had a massive downshift in stocks, huge declines in the first couple of weeks of April when tariff policy was sort of coming out and the market was digesting that news. But my point is, even prior to that, in mid-February, we started to see a decline in stocks. That was more driven by the economic uncertainty at that time versus tariffs and expectations there, because everybody was a little bit surprised to the extent that the tariffs, how broad they were. So we have this noticeable drop off in stocks starting in mid-February. We have a massive increase in volatility. That is another sign that the stock market is digesting bad news or a deteriorating economic climate and also pricing in like, hey, things are going to get a little worse in the future. But even stocks are a confusing sort of mixed bag indicator right now because we've had a very swift recovery in just the last few weeks. If you look at your investment portfolio right now, you might actually be up a little bit for the year. Even pretty aggressive investors like myself, I had the courage to look yesterday and I was like, oh, I'm up a little bit for the year. So right now, the current market environment that is driven by tariff policy. So if we get some good news like we had with China, then markets react to that and you have this huge run up. If we get some bad news like we had in the early part of April, then you have these scary days where it's like 1,000 points a day drop in the Dow. Then the next day, another 1,000 down. So until policy on tariffs becomes clear, and also we begin to see some hard data about how tariffs are impacting the economy, things like inflation, employment. We just haven't seen that. There hasn't been enough time yet. So it's tough to say how any sort of tariff related slowdown is actually going to impact the economy at this point, especially with the tariff policy still in flux. Most businesses and many people are just in a wait and see mode. And that, unfortunately, is enough. If you're not buying anything, if you're a business, you're not hiring people, if you're not investing because you're just waiting to see what happens on the tariff policy, that is more than enough to push the economy into a recession. So there's just too much uncertainty. I see that in housing. Actually, this is the time of year where the housing market really gains momentum. Like people list their houses in the spring. There's a lot of activity selling. It's like, if you're a realtor, like this is the time of year where you make your money. And I have seen more listings and sales, but not what you would typically expect. And I think, there's a combination of things, higher interest rates. You have uncertainty about jobs. That has kept many people on the sidelines. I'm starting to see that in housing prices. Now, a lot of this are things I read broadly across the United States, but the interesting thing about the housing market is that it's so local and particular. So housing market could be great in your location. It could be pretty awful. Places like, I know Florida is really struggling right now. Where I am in Oregon, some of the housing market is just driven by the higher tax environment policy. We've had net migration out of the Portland metro area in Oregon, where I'm from. So there's a lot of local factors there. But what I'm seeing, because I get Zillow emails every day, I see consistent price declines and price cut 50,000, price cut 200,000. I'm seeing that pretty consistently. And the houses that are stubbornly not lowering their price, they're just sitting there. I have 2 houses that are in my immediate neighborhood. There's only like 20 something houses in my neighborhood. And 2 of those have been for sale for months. No movement. I don't see a lot of activity. One of those actually just went pending, but only after a pretty significant cuts in price. Like everybody's thinking that their price is worth what it was worth back in 2022 when housing prices peaked. And it's like, no, that's not the case. So houses are selling, but who wants to lock in a mortgage at 7% right now? Related to that, consumer confidence, that has fallen hard. It declined for the 5th consecutive month in April. So again, this is a pre-tariff deterioration, and it is now at a 13-year low. And so you cannot blame tariffs for this. The uncertainty with tariffs has certainly made it worse, but this was actually trending lower for some time now. Now, this is an area that I am particularly concerned about. I think you have a very marked split where you have higher income Americans, especially homeowners. Many of you listening to the podcast, you have assets. You have a 401k. You've seen your wealth grow over the last several years. But middle class and working class Americans are really struggling right now. Higher interest rates, higher cost on everything because real wages haven't kept pace with inflation. So we're seeing credit card delinquencies, student loan defaults, car loan delinquencies. People are using buy now, pay later on groceries right now. We have car loan delinquencies that are at their highest they've ever been. People are missing car payments at a rate that surpasses 2008, 2009 even. The hard part here is that no one really knows. Even the official sources, they're always late to the party and calling a recession. And employment is also pretty stable right now, but keep in mind that is one of the last dominoes to fall. It doesn't spike usually until everything else has pretty much rolled over. And so to answer the question, my gut tells me that we are already in a recession. And recessions, although painful, they're actually healthy for the economy long term. I know it hurts individual people in the meantime, and it is very painful. And nobody wants a recession, myself included, but they do help to flush out the excesses that can lead to a bubble environment that can lead to a much worse financial or credit crisis later on down the road. So I think that what we're seeing right now is the excesses are starting to flush out. And my hope is that this recession, if I'm correct, and we are in one, or at least headed for one, will be short-lived, not too severe, and what I think is a badly needed reset for an economy that's been all out of whack since COVID. All right, that's it for today. Thank you for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.